Hi there, this is Alvin from Dr. Well. Yesterday, the stock market in the US have done very well after the FOMC meeting, and some investors were thinking, is the worst over for the US markets? So in this video, I hope to give you a quick update and my views of what do I think the market might be heading next. So the FOMC has just announced a 0.75% rate hike and should know by now. And it isn't a surprise to the market because that was what the market were guessing, analysts were saying. So it came as like something just out of the script, right? Now, nothing surprising. And the stock market rallied, right? You can see the S&P 500 was up 2%, and then the NASDAQ was up 4%. So these were very good results, and these were unusual because in the past, when there was a rate hike, usually the stock market goes down, especially the tech stocks, which is NASDAQ, tends to track, right? They used to be going down instead of going up because this rising interest rate actually hurt some of these loss-making stocks more than those that are already making profit today because a lot of their future earnings get discounted to today's value, which with high interest rate, the discounting is a lot heavier. So this is something that's unusual, right? But I want to give you some of the possible reasons that caused this rally to happen. So the very first reason is that as I said, the market has already expected this 0.75% rate hike. And the Federal Reserve has done very well in communicating the future plans of raising the interest rate further. So this is not the end of the interest rate hikes, and we expect more until the end of the year. But because the market have already priced in this expectation, so I believe that nothing surprising is actually good news, right? So in this case, a 0.75% hike is expected, and that's why the market kind of welcome it instead of getting upset about it. And then the second reason is because nowadays people are really feeling a pinch in their pocket that things are getting more expensive, inflation numbers are going up, and it has become a public enemy number one. And they love that the Federal Reserve is actually willing to raise interest rate to combat this inflation problem. So that is the second possible reason that why the stock market is rallying. And then the third reason was due to the Federal Reserve Chairman's Freudian slip, and he said something that was not in the script, which he said neutral monetary policy. So what that means is that the policy, they believe that at this level, this interest rate level, it neither stimulates the economy and it also doesn't restrain the economy. So this is like the equilibrium that the Federal Reserve think that interest rate is going to be at. And what is the implication of this is that that means that investors are probably expecting that the rate hikes in the future might not be as high as what was initially planned, right? Because it's already at equilibrium. If they raise further, it's going to restrain the economy, and if they cut further, it's going to stimulate the economy as well as fueling the inflation. So market is reading this neutral term as okay, so which means that further rate hikes are going to be much lower, right? It's not going to be very drastic, and that's why the growth stocks are rallying. Okay, because now then because the stock market is forward looking, right? They expect the rate hikes are not as serious as before. So that's why the valuation also gone up, the share price gone up. Okay, so reason number four is could be that the Federal Reserve Chairman also said that the economy is not going to a recession, right? So he quoted examples of like certain parts of the economy, the indicators are looking well, like especially the job market. The jobless rate is low, and it doesn't look like a recession, right? So he actually dismissed it, and he said that don't take the GDP numbers with a pinch of salt, right? So because it's very hard to measure a big economy like the US, and we will know, right? But market take it as that is probably the case. Okay, so these are the four possible reasons and why the markets are rallying. Okay, so despite the stock the rate hikes are going on. And if we look at the market, why do I say that it's unusual? It's also because the NASDAQ has its best one-day gain since 2020. Okay, we all know that 2020 was the COVID year, and a lot of stocks tanked very quickly. And usually the best and the worst days also happen during the crash, right? So the rebound was also very fast. And it has been 2 years since we have such good news, such big bounce, right? NASDAQ going up 4% in a day. And this is unusual, right? Especially on a rate high day. Okay. So it's the worst over, right? And we even see those kind of risk on stocks, okay, those stocks that are fast growing, but may or may not be profitable. Like Unity is not profitable, Pinterest is not profitable, right? So these are the cases where it's very unusual. They don't have any special news. In fact, Shopify was saying that they just cut like 1,000 staff, 10% of the workforce, and yet the share price the next following day gone up 12%. So it seems like it's a macro driven kind of news that's going on in the market. It's driving all these risk on stocks up. Okay, so these are the unusual things, right? We shouldn't be seeing this rarely, given that a lot of bad news are still unresolved, right? So is the worst over? Personally, I think it's too early to tell, right? It's too early to tell because when I look at the bigger picture, I'll blow it up bigger for you, right? Look at the chart. This is the S&P 500 ETF chart. Okay, so it tracks, of course, the S&P 500 index, and what is important is in this chart is that I have drawn certain moving average line. Okay, so the red line, focus on the red curve that is on the chart itself, is a 200-day moving average. That's like the long-term moving average. Okay, that is the basis where we tell whether a market is bullish or bearish. So when the prices in this case are below the red line, that tells us that actually the bear is still in control. It is still early to tell whether this rally can sustain itself, right? It's not bad, okay, because for the last 2 weeks or so, the share price in the US markets have recovered, okay, has recovered a certain degree, but it is not confirmed yet that it can continue to sustain. Okay, it's still too early to tell that this is a bull, right? To me, this is still a bear. Okay, until the prices are above the red line, then we can say that okay, the bull maybe have come back in control. But right now, there is a possibility that the share price can go down further. All right. So, and how then do we, deal with this? Okay, so I want to use the analogy like the tsunami, and don't know whether how well you know about tsunami. Okay, tsunami. Okay, because my understanding is that a tsunami usually don't happen in one wave, right? So it can happen from 2 waves to even 10 waves. Okay, so it's a series of waves that can come in again and again and again, and usually the first wave isn't the worst. Right? Yeah, usually it's the second wave, or even after you get a much bigger wave than the very first one that you see, right? So what's the point of telling you this analogy is that we just have you can say that we just have seen a first wave of selling since November last year, when the Federal Reserve start to raise interest rate more aggressively, right? The first wave of selling has been done. Okay, so right now we are seeing some retreat, right, of this wave. Is there a second wave coming? Is there a third wave coming? There is a possibility, right? So I'm using this analogy to say that we are not out of the woods yet. Much bigger drawdown, second wave of selling is possible. Okay, it's too early to tell that we have really reached the bottom, right? So my view is that still be cautious, right? We never know the second wave, when is it going to come, or is it ever going to come? All right. So I'm not convinced that the worst is over, and I do think that, but I do know that I can change my view, right? Depending on how the market moves from here, it's in the no man's land right now, right? We need a lot more bullish days, and get the price above the long-term moving average in order for us to call a bull, right? But that's it, right? As what I'm doing to my portfolio, I have long-term holdings. They are growth stocks, or stocks that I think that have more long-term value, right? I'm going to hold them for many years. Okay, I'm not tempted to sell them because I think that the market is going to crash or what. I'm just going to hold them. Okay, so long-term wise, I'm not going to touch majority of these stocks. But in the short term, I'm actually shorting quite a lot of stocks, especially these specs, which are, I think, are the weakest of the lot, right? So I'm long-term long and I'm short-term short, in a nutshell, right? So that's why I do think that I'm not going to take away my short position unless they hit my cut loss limits, right? But right now they are not. Okay, so I do think that in the short term, it's still too early to call that the market has bottomed, right? And then the bull has come back. Okay, so I hope this is useful for you to give you some perspective. And I may not be right, right? So only time will tell how the market will move. I'm always there to react as fast as I can because I'm not a believer of prediction, right? But I hope what I've shared with you can help you one way or another. Remember to like this video and subscribe to the channel for more updates like this. Thank you for watching, and goodbye.